Welcome to Finance Files, a podcast hosted by best friends Whitney Coford and Brittany Carter, with occasional appearances from my dad, Greg Coford, and other guests. We talk about all things finance, including investing, trading, economics, capital markets, and business management. Come learn the investor mindset with us.
As always, we encourage you to do your own due diligence, which we'll explain this week how to do in case you don't know how to do it. But everything we say is for entertainment only. It's not investment advice. If you want to use it as investment advice, bear in mind that if we're talking about something positive, we probably have that in our portfolio and we'll sell it immediately after this podcast. If we talk negatively about something, we probably are short that in our portfolio, and we'll cover that short immediately after this podcast.
So as Greg mentioned, this week our theme is due diligence because our editor, Mike, informed us that we should probably go into a little more detail about how to do due diligence, not just what sort of sources of news to rely upon. And my response when Mike brought that up, I was like, Mike, that sounds like such a boring week to talk about. And Dad, what was your response to that?
My response was great. I don't have to be on the podcast this week.
Because you don't do due diligence anymore?
No, because you and Brittany are experts on it.
Oh, right. No, but I mean, I think the reason my response was, oh, that's so boring, is because since my job is due diligence, and so it's, I'm doing it all day, every day. And so the thought of walking through the process, I was like, well, it's so obvious. But then as I was going through it and thinking, for someone who's never done due diligence, where do I start? I was like, okay, I see Mike's point. We do need to share maybe a little bit more about how to do due diligence. And I think what'll be interesting about it this week is I learned how to do due diligence mainly from Greg, from my dad, but I've probably adapted it over time now that I've been doing it for about 4 years. And it'll be interesting to see when Brittany joins us later in the week, how her process differs and has evolved. So anyway, Mike, per usual, he was right. So good job, Mike. Anyway, so Dad, since we're recording this right after the election, do you have any Market Monday thoughts? Doesn't have to be related to due diligence, but what are you thinking about for this Market Monday post-election?
Well, because of the ambiguity going into the election as to the outcome, volatility was off the chart in pretty much every asset category.
Okay, and why? Hold on, I'm going to pause you. Why does volatility matter? Why is that something investors pay attention to?
Well, there's a difference between actual volatility and implied or expected volatility. In other words, what happens is if you look at the movement in the stock price, or any other asset for that matter, that's a historic volatility that when you do the statistical calculations. Options trade off of an expected volatility because no one knows what the future is. And most of the time, the historical volatility is a good indicator of the future volatility because assets tend to trade consistently amongst the same kind of investors, and so the volatility will tend to be the same. But what happens is when there's an anticipation of extreme volatility, then in the options market, those prices will get bid up because if the future volatility is greater than what the historical volatility has been, then there's ways to make money trading that new, more volatile environment than the historical one. And the options market.
So you're thinking about volatility is basically the bottom line. So for someone who has like explain it like I'm 5, what is volatility?
Volatility is, as far as assets are concerned, is the expected amount of change in the price over time.
Okay, so like if we're looking at a stock price, the volatility would be if I'm and it can the metric for how long into the future you're looking varies by asset. Is that correct?
Yeah. Well, and the volatile nature of a security changes over time. In other words, there's greater likelihood that a security can move more in 90 days than it can move in 30 days.
Yeah, that makes sense. Like a stock, the longer the time period, the more opportunity there is for it to go up or go down in a
Right.
more extreme way.
Right.
Okay,
Right.
that makes
Right.
sense.
And in a given situation, an asset may be extremely volatile over a short period of time, and so its short dated options will trade at crazy valuations, but long term it's not expected to do that. So the long dated options will trade at a much smaller valuation
Okay.
relative to their theoretical value.
And let's do maybe a refresher on options. I know we touched on them last week, but what is an option?
Options are the opportunity, but not the requirement, to buy or sell an asset at a fixed price by a certain date. So a call option gives you the right to buy a stock, if it's a stock option. Like if you have Apple and you have a call option on that stock at $200, then that gives you, and it expires at the end of the year. Then between now and the end of the year, you have the right to buy that stock at $200.
But you don't have to.
You don't have to.
Right. Okay.
And that's why it's called an option.
Right. And like we talked about previously when we were discussing options, the value or the upside to buying the option is you can buy the option for a much lower price than what you're agreeing to pay for the stock, correct?
Right.
And then if you end up buying the stock, hopefully the stock price has gone above whatever your exercise price is. So then you're getting a good rate, basically.
Right. Right. And on the flip side, if you want the ability to sell a stock at a fixed price, that's a put option.
Right.
And so it's basically the opposite of a call. You have the right, but not the obligation to sell a stock at a fixed price by a certain date.
So if you are selling me a call option, then I have the right to buy at a certain price. Whereas if you're selling me a put option, then I have the right to sell at a certain price.
Correct.
Okay, that makes sense. All right, so now how does volatility play into options trading?
Okay, so let's say a given stock let's say it's a bank stock, and so it's going to trade off of basically a discounted cash flow model, where you look at the earnings and you say, oh, these earnings are sustainable, they can keep doing that, they're going to grow a bit. So what's that worth today? And so what does that mean for the value of a share of stock? And so that type of a stock is not going to be wildly volatile. Whereas a stock like Tesla or Trump Media is going to be very volatile, because those stocks don't trade based off of their intrinsic value. They're more like expectations.
Right.
It's like cryptocurrency. There's no intrinsic value to cryptocurrency. So the reason people buy is they think somebody else is going to pay more later.
I can't wait to see the pitchforks in the comments on. I'm just kidding.
Yeah. But and it's the same thing with a stock. The more a stock price can move up and down, the more volatile it is, and so the more likelihood the option that you're buying has the possibility of having value.
So why does the election affect volatility?
So what happens in the election is no one going into it was sure of the outcome.
Right.
And so from a perspective of the bond market, for example, the concern is, okay, if Trump wins and Trump does everything he says he's going to do, then the deficit for the next 10 years is going to be like $17 trillion. If he puts in all of the tariffs that he wants to do, that's going to be wildly inflationary. He wants to deflate the dollar. That's wildly inflationary. So none of that is good for the bond market if it happens. Now, if we look to Trump's first presidency, he did a couple of things he talked about in the campaign, but largely he didn't do much of what he talked about in his campaign. So the cost is an unknown, but the potential is what people worry about.
Right.
And so, for example, the U.S. Treasury has what the market calls the long bond, and it matures in 30 years.
Okay, so it's a long bond because it matures in 30 years. It's a long
Right,
period of time.
right.
Okay.
Yeah, yeah. And the U.S. government issues bonds in a myriad of maturities. So there's whatever you need. If you need a 2-year, they sell a 2-year. If you need a 5-year, they sell a 5. And then obviously the bonds that they sold last year are a year older, so their maturity, the 30-year that was sold last year is now a 29-year.
Right.
And since they've been selling bonds forever, you've got bonds of every possible maturity that you can imagine. So so normally the Treasury long bond options trade in single-digit implied volatilities or low-teen volatilities.
Okay, hold on. So you're talking about an option to buy a bond.
Well, actually, an option to buy the future on the bond.
Okay, so what does that mean?
All right. So futures contracts are they're also an instrument that's traded in the marketplace.
Okay, and
And
in
they
case people haven't picked up, there are so many instruments. Anyway, okay, continue.
so what a futures contract is it's an agreement to buy or sell. If you're long, then you're buying. If you're short, you're selling. To buy or sell the underlying at a determined date in the future at whatever the spot price is that day.
Okay, give like a firm example just of a futures contract.
Okay, so the Treasury long bond future trades on the U.S. Treasury long bond. So what that means is you're agreeing, so if you're buying the bond today and you hold that future right through to maturity, which is in December, then you would get delivered that Treasury bond. And if you sold a future today and hold that, then on expiration, you would have to make delivery of that bond.
Okay.
Now, most futures contracts are used for hedging or speculating, and when you get to maturity, most of the contracts have been all closed out, is usually what happens with the vast majority of them,
Okay.
most of the time. So the long bond future has an option that's traded on it. So if you exercise the call option, you're going to end up owning the long bond Treasury future. And if you hold it to maturity, you'd end up holding the U.S. Treasury. If you had a put and you exercised that, you would then be short the future. And if you held that to maturity, you'd then have to make delivery of the bond.
All right. I don't know if I'm more confused than when we started, but this has been enlightening. There's a lot of instruments, which I already knew, but it's interesting to think about how the election, which we think about as being just politics, right? That
Right.
directly affects capital markets.
Yeah, yeah. So what happened in that specific instrument is because everybody was expecting the potential of volatility, the price of the options were bid up dramatically. So the implied volatility on the options were in some instances as high as 45%, when on a normal day they're like I say, 9 to 12%.
Yeah.
So they were very, very expensive options.
Is it accurate to say that the expectation that volatility would increase caused volatility to increase?
So the question of can implied volatility create real volatility, normally that doesn't happen. But you do have extenuating circumstances like what happened with GameStop, where you had so many traders long deep out of the money calls that, and then as the stock ran up, the options market makers had to rush in to buy stock to hedge themselves on the calls they'd sold, forcing the stock even higher. So there are occasions when that happens, but it doesn't happen enough to make it a trading strategy.
Okay. So I know we're at time and we got kind of far into the weeds on this one. So for listeners who their eyes glazed over or you felt like this was over your head or there were a lot of terms that were unfamiliar, just know that this is a great example of a trading strategy and the types of instruments that a trader may use versus an investor is going to probably think longer term. They may use some of these different instruments, but generally speaking, um, we we probably got a little far into the realm of a professional trader would use these types of things versus a passive investor who's going to be looking at the longer term and using some of the more simple instruments that are more easily understandable and accessible to the average person. But always good to know what's out there and to hopefully pique your interest on areas that you could explore further. So we'll wrap it up for today. Tomorrow on Tuesday, we're going to talk about why you should do your due diligence and start touching on how to actually do some due diligence. So join us tomorrow on Finance Files, and we'll see you then.